Good afternoon, ladies and gentlemen. Thank you so much for your presence. Now I'll take you towards the revenue profile of our organization. 77% of our business comes from air cargo services. So you would have, if you see the contribution, it has been consistently growing from a 1,000 crore odd number to a 2,100 crore number. There has been a significant growth in our core business, which is air cargo. The other products are also contributing very nicely to our revenue portfolio, and it is a volume-led growth story which is happening very nicely for the group. So the ocean freight business has grown from 164 crores to 422 crores. Our express business, which is totally tech-driven and backed by our technology subsidiary, is doing really well and very well accepted in the market. The revenue contribution has grown from 58 crores to 162 crores, which is showcasing that the acceptability of our technology is there in the industry and the customers are willing to reuse our express cargo business. On the trucking side, there has been a stagnant growth, but some of the factors affecting the land transport were prominent factors in the growth being a little subdued. On the value-added services also, we are contributing nicely to our portfolio, and there is a significant percentage increase in the overall portfolio. The warehousing activity has been a new activity, although we have been doing transit warehousing for our customers over a very, very long period of time, but the focus has of late also gone into increasing our footprint into the warehousing sector as well. Global footprint, so Asia continues to dominate our revenue portfolio. We have the strategy of our organization has been to contribute to focus on the originating economies of the world and take the goods of our exporters worldwide to their destinations through the air cargo mode and the other multimodal operations. Europe, North America, South America also are contributing very nicely to our revenue portfolio, and there has been consistent growth in the contribution of the other continents as well to our revenue portfolio. Export sales from India, the growth mix is also increasing. So although the other category shows the largest portion of the dominance here, but this includes countries like Peru, Dominican Republic, Argentina, Colombia, and many others combined. The domestic location-wise revenue mix also is, the offices that we have across the country are contributing nicely to our growth. In the past 3 years, there has been consistent growth across all the country present. The strategy of the company was also to move towards the manufacturing belts of the economy, and not only restricted to the metro stations, but we have also tried to move with the customers. As and where the customers' manufacturing moved, Skyways also increased its geographical presence, which has been a pivoting factor in the growth journey of Skyways. Operating metrics, so a very healthy growth in the number of customers we have seen in the last 3 years. From a 7,400 customer base to now 9,500 customer base shows the confidence of the customers building in our product portfolio. The express company's contribution on the customer addition and the core business of air cargo all are witnessing significant growth in the last 3 years. The revenue per customer also has been healthily increasing from a 17 lakhs to a 29 lakhs number. On an overall basis, consolidated basis, the presence in number of countries has been, we have been adding geographies in the last 3 years. Although there have been global turmoils, we have witnessed situations of war and geopolitical tensions across the globe. But we have, the strategy of the company has been to increase our presence in the originating and the manufacturing economies of the world. And since we are very strong with the air cargo division, the top company in terms of the air export, we feel that these geography additions, the anchors of the airline relationships and the shipping line relationships that are there for the last so many years are helping us to grow on this side of international geographical expansion. The number of industries served also, we have tried to increase our presence in the number of industries that we serve, and it's a very healthy number of 60 plus industries that we are serving now. Commodity wise, revenue concentration, just to take you a bit in the past, when the COVID struck the entire world, the importance of the pharmaceutical industry and medicine industry came into the foray. And Skyways also at that time, created a vision of expanding into the pharmaceutical sector. The pharmaceutical sector has been a consistent growth driver for the economy and has been growing at a roughly 10% CAGR over the last so many years. And we also, on this strategic point of view, diversified and created our more footprint into the pharmaceutical sector. So now roughly around 23% of our business comes from the pharmaceutical logistics space, and followed by textile, spare parts, and many other industries. The revenue contribution from the pharmaceutical segment creates a little bit of concentration in terms of the top 10 companies, and we are really proud to serve the largest giants of the pharmaceutical sector, and accordingly the top 10 contribute around 20% of our revenue portfolio. But then if you spread the business on other industries, our revenue portfolio from various industries are contributing very nicely to the growth of the company, and the customer base is expanding very nicely for us. On the peer comparison, on the EBITDA margin side and on the revenue increase, so we feel that we have done really well in the last 3 years vis-a-vis the industry comparison. Although these competitors are not strictly comparable with our core business, but they have a common business activity, whether in the air cargo cross-border business or in the domestic business. So these companies have been selected by the DNB independent report as our peer closest competitors. From the profiling, you will see that our return on the ratios on the balance sheet side are really healthy, and in the industry leading, to say the least. On the EBITDA margins, yes, we have been a little behind, or the industry margins of the competitors, the EBITDA margins are slightly higher. But in the last 3 years, we have witnessed decent operating leverage in our business. From a 3.75% operating margin, we have now increased our operating margin to around 4.5%. On the ROC levels, we are plus 18% return on capital employed, which showcases the model being asset light, and our net profitability margins are in better or maybe compared